And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Huge day, huge month for the markets. You know, the S&P is up 10% the last 6 days. Historic high today. Our guests, as always, three of the best in the business. Nicholas Colas from DataTrek, Matt Bartolini, head of Spider America's research with State Street, and Brendan Ahern from Crane Shares will be joining us shortly to discuss China. Matt, you control the Spider S&P 500, the biggest ETF in the world, $300 billion just in that ETF. Huge volume today. I see. It looks like 2.5, 3 times normal. What do you see from your perch watching these ETFs today?
Yeah, well, I think a lot of what's happened is the market is viewing this very much risk-on sentiment. We're seeing investors step into that market and utilizing a tool that they quite frequently use a lot when there's market action, and that's SPY. We've seen a lot of volume in SPY come in as that risk-on sentiment has taken shape. But also, when we look at other products within our lineup, we've seen massive volume spikes in areas that are more cyclically oriented, like oil and gas exploration and production, so XOP, or within banks that are also very macro-oriented, what we're seeing in the move in rates, KBE. And what's really interesting, though, is with the volume we've seen on those two ETFs, as well as the price action, both of them are up double digits today. Prior to today's action, we actually saw a buildup of short interest. So there could be a little bit of short covering in those two segments of oil and gas, banks. We're seeing this also within real estate and other sort of reopening type of trades that are also tied to some of the macro variables of higher oil, but also higher rates.
Yeah. Nick, this is a big day for value over growth, but it's one of the only days of the year. I mean, it's been a very short runs that value's had over growth. Is this going to put value ETFs and value in general, the value style investing back? As you've noted many times, we've discussed values, mostly financials and some healthcare stocks and a little bit of energy and some industrials. Is that finally investment style going to come back at this point?
It does feel that way because of the sector allocations that you noted. I mean, because technology had such a huge run over the course of the past couple of years, the growth style, if you look at the S&P 500 growth, became 41% tech. 38 points of the 41 was just big tech, and it had basically no financials, 4%, and less than 1% energy. And that kind of weighting worked for the past couple of years. But if we're well and truly back into full-blown recovery mode, which I think we are, then you do want to look to the value side of the trade, where you do have healthcare as 21% of S&P value, financials 19%. They should be good beneficiaries. Energy at 4% versus that less than 1 for growth also feels like a better way to be positioned. So it isn't so much that, quote, value is going to work, but that the sectors that are value sectors, low PE sectors, they should work.
Yeah, and I've noted, and you and I have talked about this, Nick, that in Europe and in Asia, financial stocks are an even bigger weighting in not only the markets, but in the value play. So if, you're suggesting, value is starting to work better, then Europe should have an even bigger move overall in the value area, as well as Asia. Am I right?
Oh, totally right. I mean, S&P 500 is 10% financials. In the EFA, which is Europe and Japan, it's 15%. In emerging markets, it's 17%. So orders of magnitude more weighting in financials. And with hopefully higher long-term rates and a steeper yield curve, that sector should work. Those areas should work.
I just want to go back, Matt, and talk about the cyclicals, because you referenced earlier the XLRE, which is the real estate ETF. It's up 8%. I mean, there's your, return to the office trade. That's kind of obvious. We're seeing REITs move rather aggressively today. We're also seeing aerospace, with another cyclical group, aggressively move. That's certainly understandable. Boeing's been a mess, not just on the problems with travel, of course, but also on the issues they've had with their planes. Any thoughts on real estate from here on out? I mean, I don't know anybody, people have said this before, that wants more space. I mean, that is a problem. Maybe people will get back close to their old space, but most people are still looking for less space. I'm just wondering, what's the right value? How do you figure out the right value for something like the real estate space right now?
Yeah, I think what a lot of happening today is a lot of these areas are sort of beaten down, right? So aerospace, some of those stocks have been some of the worst performers we look on a broader year-to-date basis as a result of the drawdown we saw in March, as well as banks and oil, right? And those are obviously value-oriented plays, and that's why value is doing so well today. It's a little bit of a sort of a knee-jerk reaction to some really positive news. Don't get me wrong, I think one of the things is looking to see if this is sustainable, right? So if we do get a vaccine, we obviously still have the Pfizer one on the table. It still has to go through safety trials, and you never know what's going to happen there, and as well as the distribution of it. So I think what is happening is, what we're also seeing from a short covering perspective. If you look at the top decile of highest short interest stocks in the Russell 1000, they're up around 6% today. And the ones that are least shorted are up around 3.5% today. So it's a little bit of just covering some of those beaten down segments. And the sort of vitality of the cyclical trade is still left to be somewhat questioned of how quickly we can get this vaccine and how quickly we can get back to sort of normal trendline growth. So when you see real estate moving higher today, as well as banks, some of this is hopes of higher growth, but also some of it is just covering up some of those beaten down areas that have been shorted going into this marketplace.
Yeah, Nick, same question. I want to stay on the value theme and go back to banks. And again, you and I have talked about this in the past. I mean, rates are up today, so net interest income should be up. That's good. And yet the other component, I always point out, loan growth, the other critical aspects other than fees for banks, still looks pretty anemic into 2021. Do you see any possibility that could change? I'm trying to figure out the same problem I have with banks I have with real estate. What's the right price for them? More appropriately, what's the right multiple that we're willing to put on them? How do you look at the banks, for example?
Yes. I mean, I think of the banks in terms of just structural earnings power. How much can they improve over the course of the next couple of years? Because this year was obviously a disaster. On the plus side, they are the cheapest group in the S&P by an order of magnitude. It's like 12 times earnings for next year. Next nearest group is like 15 times earnings in financials. So there is basically zero expectation of structurally improving earnings growth. And if you buy off on the idea of cyclical recovery, the financials should begin to take their place as a leadership group. It's been very problematic so far, as you know. But if basically my thought is if it's not now, then when? Because if we really do believe the vaccine plus stimulus is going to give us a better economy in 2021, financials should work. If they don't, something much deeper is wrong with them.
Yeah. I just want to go back to the international markets a little bit. And we saw Matt, last week the markets really move up internationally. Some of the big international ETFs like GXC and FEZ, that's the European ETF, moved rather aggressively on last week, and they're moving again today on the vaccine news. Can you give us a little, Nick's given his comments on the international aspects of this. Can you give us your thoughts?
Well, I think the market action we saw last week is reacting to some of the polls and ballots that were already been cast and counted as the week went on. If under a Biden-Harris administration, foreign stocks would likely be more beneficial to have in your portfolio than, say, U.S. on a relative basis, just because Biden is more of a globalist. We're likely to see a reprieve of some of the tariffs and sort of more formal pacts within some of the nations where they put some levies on. So that would be overall net positive growth for international markets like Europe as well as China. And that's why we saw some really strong action last week. And then carry on today with the vaccine news. I think that's only going to add to the positive sentiment in that region, particularly as Biden gets into the office.
Yeah. I want to bring in Brendan Ahern from Crane Shares here, an old friend of mine, an old China watcher. Brendan runs the China Internet ETF. KWEB is the symbol there. He also runs the China A Shares ETF, which is the China mainland. The symbol there is KBA. Brendan, thanks for joining us. Before I ask you about China, I want to ask you about the sort of international market question that we had just been discussing here with Matt and Nick. The markets globally seem to have rallied on some hopes that there would be that Biden is a globalist and there'd be fewer tariffs maybe out there. Can you give us your thoughts on that? Do you think there will be less international tension and fewer tariffs?
I do. I think that Biden is clearly going to take a more pragmatic approach, less tweets, less temper tantrums, kind of more traditional diplomatic discussions. So I do believe that it is a net positive for non-U.S. equities, and I think the markets are proving that out.
Yeah, I guess the problem, the only pushback I would give, and any three of you could answer, is Biden himself is still somewhat hawkish on China, number one, and number two, there will be some pushbacks about just completely removing tariffs in the Congress on that. I mean, is that really a truly done deal? Anybody want to go in on that? Because that's the concern I have. I mean, it seems like there's going to be some pushback.
Yeah, my one view, Bob, is that Joe Biden got elected to focus on domestic issues. And I just think, China was a little bit of a distraction technique for Trump. Look over there and not in the mirror. And I think Biden will be much more focused on a domestic policy, and I think international policies, if it's tariffs, if it's going, threatening China. I mean, I think we can kind of call it what it was. It was simply a distraction technique, and I think Biden was elected to focus on domestic issues, and I think that takes some of the scrutiny, at least dials it down a notch.
Yeah.
Don't you think, though, that there's still... Go ahead. Go ahead, Matt.
No, I think there's also just more of a procedural issue, too. Trade powers are much stronger within the White House. They don't really need congressional approval, as we saw under the Trump administration by, executive order placing tariffs on China and countries within Europe. And I think you could see the same, but reverse, under a Biden administration where it seeks to be more globalist and use more trade partnerships instead of actual individual tariffs targeted at one specific country.
Yeah, I would agree. Biden is more of a globalist. He'll certainly try to get us back into the Paris Climate Accords. But Nick, for example, he seems to be a bit of a hawk on the global supply chain. I mean, I think there seems to be clear efforts or noises to continue to bring certain critical parts of U.S. Infrastructure back. For example, medical supplies. I think we all got caught a little flat-footed about how much China was producing of our medical supplies. Don't you think, Nick, certain trends are going to continue, like, bring certain supply chains home?
Yes, you certainly nailed exactly the right one in terms of long-term trends. Localization of supply chain, definitely an issue. What I'm looking for is to see what happens with all the blacklisting of Chinese companies that we saw under the Trump administration. And if we begin to see an unwind of that, particularly with Huawei going into 2021, because what's so important for Chinese equity investors, and Brendan can talk to this as well, is where is technology going in the Chinese stock market over the next couple of years? Because that's really been a key driver of why that market's done well, particularly this year. And can that continue with a easier overall trade policy and IP policy from the U.S. towards China?
Yeah. Brendan, you want to respond to that?
No, I would agree with Nick. Always good to be in agreement with Nick. But yeah, if you look at within KBA, we have a higher weighting to Shenzhen than other definition of Chinese A shares. And Shenzhen Stock Exchange is up 3 times as much as the Shanghai. So Shanghai, more value sectors, mega cap, large cap. Shenzhen, more growth-oriented names, predominantly tech, mid cap, small cap. So some element of KBA's outperformance has been driven by having a little bit of a higher weighting to Shenzhen. And to Nick's point, overnight you had a lot of the tech war sensitive securities, ZTE, a lot of the 5G names, a lot of the telecom names rallied very strongly on a more pragmatic approach from the Biden administration.
Yeah. Brendan, while I have you here, I've got to ask you about the Ant Financial IPO. We were all, it was a sort of second or third tier story last week given the elections, but everyone was absolutely stunned when all of a sudden we were waiting for it and they just decided not to do it. And I'm wondering if you can, this is the biggest IPO of all time, so it's not, it's certainly very important. I'm wondering if you could tell us, do you have any sense of when it might actually occur, number one? And number two, what exactly happened here? Was there a problem with them trying to basically teach a lesson to Jack Ma about being so outspoken? Or is there some other issue going on here that is not quite as obvious, or some other subtlety that we're missing? Can you just lay it out for us briefly? Brendan, you there? I think we lost Brendan. Well, here's the important point, people, and I don't know if anybody wants to weigh in, or Nick or Matt, you want to weigh in on this at all, but the key thing here was the Chinese authorities wanted to imply somehow that they needed to get more control over Ant Financial, that this was essentially a company that was doing massive amounts of loans in China, and essentially then pushing the loans off to the banks themselves, that they actually had no real skin in the game. They were simply facilitators. And I think Chinese authorities were very nervous about that. At least this was the story. I wanted to get Brendan's reaction to that. But the way it played out in the Western media, it was largely, oh, Jack Ma, I think having sensed this was happening, came out and said, well, this is crazy. There's too much regulation of ours. And he was responding to the pressure that the regulators were putting on him. So I guess the question here, Nick, and I don't know if you have a thought on this, is it seemed to me what really happened here was Chinese authorities were already sending noises out there to them that they were going to be subject to more regulation. And Ma was angry about that. And Ma's reaction caused them to bring him in, but it wasn't going to stop the fact that they were going to try to get more control over them. So it's a very interesting sort of situation. Matt or Nick, you have any thoughts on that?
Yeah, I mean, I think you got structurally the right narrative. The one thing I would add is, if you look at the Chinese online payment system, it's dominated by two players, Ant and WePay. They have like 80% market share in the online payment space, and it's something that has really astounded other central bankers. I mean, Federal Reserve officials like Loretta Mester have talked about how odd it is that two companies dominate that. And I think the Chinese government has looked at it and said, yeah, that really is actually a problem. And we do need to work on figuring out how to structurally make it more sound, because it is probably the biggest structural risk to the Chinese banking system. So unfortunately, they came to that realization a bit late for this IPO. I'm sure it'll happen at some point in a year or two, but it is, it was probably the right regulatory thing to do. It just wasn't particularly handled well.
Right. I completely agree with that. I cannot believe that the Chinese authorities waited till 5 days before they started. I mean, obviously there were negotiations going on before. See, I think that's what happened. Ma responded to the fact that there were all these negotiations going on, and he vented his frustration in the weekend before the IPO, and then they had to call him in. But they didn't cancel the IPO because Jack Ma sounded off. They were having problems, the authorities, already. And I think you're right, Nick. Who could blame them? You've got the biggest lender in China out there that's not really a bank, that's facilitating all these loans, that doesn't have any loans on its book, because we're just an application center, and ultimately it's the banks that hold the loan. Well, that's an awful lot of loans to be pushing out from the public, and that's a big issue. I think we've got Brendan back right now. I don't know if you'd heard us before the question, Brendan. I just want to get a quick response from you about, number one, do you know when the IPO might actually happen? And number two, could you just give us your quick narrative of what happened? We've had a brief discussion about it without you, but go ahead.
Yeah, I mean, very unlikely to happen until about at least a minimum of 6 months. I think it looks like this thing had the rug pulled from underneath it, and to some degree it did. At the same time, you had this more regulatory environment coming. The company really portrayed itself as a technology company, got that very high valuation, but it was going to increasingly fall under being regulated like a bank. And I think the regulator said, all of the revenue profitability is in the IPO prospectus is backward looking, and under this new regulatory regime, the company is still a great company, but certainly the level of profitability is going to come down. And so I think as much as it's a disappointment, I think the regulator is saying to investors, you need more insight into how the regulation is going to affect this company going forward.
Right. That seems completely reasonable to me. And Nick and I have been having this conversation. But I guess what frustrates me is, why wait now? I mean, it was 5 days before the IPO. It seems like Jack Ma responded to all of this pressure from the regulators saying, wait a minute, you're just offshoring, you're just pushing these loans off to the banks, but you really are a lender, and we may regulate you like that. That seems very reasonable to me. They've got to get a hand around this. But why 5 days before or 6 days before? This should have been something that came out a couple of months ago. Don't you think that's reasonable, Brendan?
Yeah. I mean, I think the company really drove to get the IPO up in advance of the new rules being implemented. And so I think the regulator's hand was forced to some degree by how quickly the IPO came together. So the regulatory environment's been coming. It's just more the IPO came faster.
I see. Okay, so your point is this is kind of a game of chicken they were playing, that if they could get this thing out before the actual regulations came in, then they're too big to fail. You can't regulate us now because we're so big. Was that the game? It's a game of chicken, right?
Yeah. And you have all this retail money, predominantly individual investor money in the IPO, and the regulator wasn't going to do something to hurt the company, knowing that you'd only be hurting all these mom and pop investors. So So I think actually the regulator took a pretty pragmatic view, and for both parties in the long run, it's probably a better outcome.
Yeah. So here you see a situation where the regulators actually were very reasonable. I mean, U.S. regulators would probably have the same concerns, Brendan, wouldn't they? I mean, the way this played out initially, it sounded like the Chinese Communist Party has come down on this icon of, international, freedom and liberty. And while I love Jack Ma, the truth is a lot more subtle than that. Am I characterizing this right?
Oh, I agree 100%. And if this IPO had come on the New York Stock Exchange, for instance, or the NASDAQ, institutional investors would say, hey, what about this new regulation? Your numbers look great, absolutely fantastic, right? 17 billion of revenue, 10 billion of gross profit. But what would the new numbers look like? And I think institutional investors would have called the company's bluff if it had come here in the United States, and that's why they went local.
Right, and what your point is, what would the new numbers look like if they were regulated like a bank? Is that how they would be different?
Yeah, exactly. I mean, your gross margin of 58% is coming down, right?
Yeah, that's a good point.
For sure.
Okay, thank you, guys. We went a little bit long, but as you see, there's a lot going on here, and there's a lot to discuss. And these are the guys who've got skin in the game, advisors and people who own the ETFs. Thank you, everybody, for joining us. That does it for this week's ETF Edge. You can get all our videos, you know that, etfedge.cnbc.com. And don't forget our podcast. We go into a little more in-depth on some of the subjects today. Thank you, everybody. Have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.